We're joined here on set by Elizabeth Burton, client investment strategist at Goldman Sachs Asset Management. Elizabeth, great to have you with us.
Thanks for having me.
You don't think the Fed's going to actually pivot until later this year, much later. So how are we set up in relationship to that expectation? Because it feels like but market participants are expecting something much sooner.
Right. We believe that the pivot will start around March and continue in 3 cuts and then go to a quarterly cut cycle. In terms of the folks that I talk to most, which happen to be the institutional community, which are here at this event today, they're not trying to act on these individual decisions. They're thinking about the longer-term effect of a higher interest rate environment, which even if we at Goldman Sachs believe that interest rates are coming, as a former CIO and allocator of an institutional fund, I still think I would be thinking about the risk to the upside that we're in a higher for longer environment still.
Do you think that, Elizabeth, is being reflected, at least in the stock market, through the Russell 2000 small caps, where the cost of capital that's higher, right? Obviously, these are more of a headwind to them, let's say, than the large caps, which are not dependent a whole heck of a lot. They seem to be fine either way, lower rates, higher rates, that sort of thing. Do you think that's what's being reflected in the disparity between the S&P 500 performance closing today at a new all-time high versus the Russell 2000, which is still down 20% from its all-time highs late 2021?
Well, on the small cap story, like one thing that they are taking advantage of still is they also are able to take advantage of some of these short-term rates. Like they're also putting their cash in higher rates than like their large cap counterparties used to be able to do. So they're not totally getting hurt in a silo by this rate type of environment. Why they're underperforming versus their larger peers, I don't know. But to the points made earlier on the show, I do think the concentration risk is something that we need to be aware of. And I do think it's time to look at small caps. I know there was some discussion earlier in the week on why people on the show may not agree with that. But I think in general, the risk of doing nothing is pretty great here with such a large exposure in the U.S. pension community and corporate pension community.
We're an alternative asset class conference, and you're here. So connect those dots. I mean, what are your thoughts about that this year?
Right. So I've been coming to this conference for years, even before I was at Goldman Sachs as an LP. It's one of my favorite events. And I think what's interesting this year is that we've seen a resurgence in interest in hedge funds, which the last couple of years coming to this event as well, I'm sure you saw a lot of interest in private credit and private equity. There's still a lot of interest in private credit and private equity. What's interesting to me about the interest resurging in hedge funds is I think it's actually partly a liquidity story. Investors aren't so much hurt by this denominator effect. Now they're hurt by not getting their cash returned to them. It's a fraction of what it has been in years past. And so I think, one, they're looking at hedge funds as a way to get access to alts in a more liquid fashion. But two, they're still concerned about these geopolitical event and market risks that you've been talking about. And sometimes it's hard to put on an option strategy and know which one might pay off for, the myriad of scenarios you're trying to prepare for. And hedge funds might be one way they're trying to mitigate to that.
What kind of alts?
What kind of alts so we like real estate debt. It's one of our favorite trades going into the next couple of years. We still like private equity. I think what's interesting from the allocator perspective is, 3-4 years ago, there was so much cash to deploy into alts. Just every private equity fund that came into your shop, you'd consider giving money to if they had a strong track record. Now you have to be more selective. You don't have as much cash to go around. So interestingly, strategies like renewables and sustainable and impact investments, these are all getting a lot more attention because what the focus is now is, do you really have the operational capabilities to increase margins, grow them over time, not just have some fancy financial leverage gimmicks.
For an area like sustainable, though, is there concern that higher rates are going to make it more difficult for products to get off the ground?
I think higher rates are an issue for all alternative asset classes, right? So infrastructure was a good play last year, but you saw a lot of deals not getting done because buyers and sellers are having to re-underwrite based on the higher rate environment. So I think that's going to be problematic for all alternative asset classes within a higher interest rate environment.
Elizabeth, what do you think the primary reason for, let's say, only 3 cuts versus what the market was expecting, let's say, a month ago was maybe 5 or 6 cuts? What will be the reason for that? Will there be unexpected growth that you know what I mean? Essentially that some of the naysayers, who are still planning on a recession coming at some point, what will the reason be for only 3 cuts this year?
Well, I think what we've heard from the Fed speak coming out is they want to take a measured approach. That language might change when we hear more language coming out in the coming weeks, but I think that they want to see that we're trending in the right direction. Inflation isn't made up of one data point. It's made up of a lot of data points, and they're not all constantly trending in the same direction every single print. So I think part of that is that measured approach to sort of see, as the data continues to play out, which parts are stickier than others.
Elizabeth, thanks so much for joining us. Great to see you here.
Thanks for having me.
Elizabeth Burton, Goldman Sachs Asset Management.